It is backtesting day. Let's have some fun. All you want to know about which entry to combine with which exit and which exit to combine with which entry will be clearer after today, at least for these 5 markets. So entries and exits should not be treated as independent phenomenon. An entry that is incredible for one type of exit can be devastating for another type of exit. Knowing which entry to combine with which exit will save you from making costly mistakes, making you a more profitable trader over time. And that is why I gave up on sleep last month and spent 100 hours doing this study. Backtesting 50 entry and exit combinations for long trades and backtesting 50 entry and exit combinations for short trades on 5 different markets. When I talk about trade entries and trade exits, I'm talking about the rule-based conditions defining when we are entering a trade and when we are exiting a trade. One example of an entry is going long whenever RSI 14 goes below 30. RSI 14 smaller than 30. And one example of an exit is exiting a long trade whenever RSI 14 goes above 70. RSI 14 bigger than 70. I will in this video go through all entries and all exits that I used in this study in detail. By the way, after I made this video, I spent a couple of hours building the ultimate algo for each and every index based on the findings of this study. One for long, one for short, for the 5 different indexes. So if you want these 10 algos, you can get them for free. Just click the link in the description and I will send the algos to your email. Okay, here are the 5 different trading entries that I used in this study. 1 mean reversion entry, 1 trend following entry, 1 volatility momentum entry, 1 volatility expansion entry, and 1 price action entry. I combined and backtested each and every one of these entries together with 10 different exits. A time-based exit, 3 different trend following exits, 1 mean reversion exit, 1 risk plus trend exit, 1 target profit exit, 1 volatility momentum exit, 1 momentum strength exit, and 1 price action exit. I then did these backtests for both long and for short trades for the 5 different indexes, meaning that I made a total of 500 backtests. You will notice that these entries and exits aren't refined, they are basic, and that's the point. The goal in this video isn't to build the most optimal entry, nor is it to build the most optimal exit. The goal is rather to get a better understanding and a feeling for which kind of entries works with which kind of exit. When you do have a better understanding of that, that's the time when you start refining and improving your entries and exits for your intended time frame and index. By the way, in the description of this video, you will find all 100 codes that I have used in my backtests and in this study. The codes are for the trading platform ProRealTime, and it's all free.
Maybe you should explain what a backtest is.
Yeah, you could look at it as a trading time machine. It makes it possible to trade your strategies on historical data. What it actually is a simulation where you, with your defined criteria for your entries and your defined criteria for your exits, can run this strategy through history to see how it would have performed. And when we do a backtest, we get to see performance metrics like total gain, win rate, drawdown, etc. So that makes it possible for us to evaluate the quality of our entries as well as our exits. Okay, so in order for you to fully understand this study and the results of this study, you need to know these 6 points. All the backtests were done on the daily time frame, so this study is only considering these entries and exits on this one time frame. The backtests have been run on these 5 indexes on these date periods. The backtest position size is 1 per point, which gives more weight to the entries and to the exits in periods when the index has been higher. And in practice, that means that the trades in the later parts of this date period has had a higher impact on the results. The backtests were done on the ordinary open hours of the different indexes, so we haven't used any instruments that trades outside the ordinary market hours. This also means that all entries and exits were executed in the morning the next day after the entry and exit conditions were fulfilled. The only exception from this is the stop loss, which is executed immediately when the price reaches that level. Spreads and overnight fees are not included in the backtests. All strategies have, in addition to the backtested exit, also a stop loss of 5% and a zombie trade exit that exits the trade if it's been ongoing for more than 20 trading days. Okay, let's start by going through the 5 different trading entries. They are all very simple. And by the way, if you want me to backtest another type of entry, drop me a comment below. I read and answer all comments. First up is our mean reversion entry. It's simply entering a trade when RSI 14 drops below 30, signaling an oversold market. For our short trades, we are entering the trade when RSI goes above 70, signaling an overbought market. So this entry is strong at catching oversold bounces in bullish markets and overbought bounces in bearish markets, but has the disadvantage of struggling during prolonged downtrends or in prolonged uptrends. Here you can see an example of the entry for Dow Jones. We have a price drop here from the mean, and we enter the long trade here when the RSI 14 indicator goes below 30. Our second entry is a trend following entry where we enter the trade when a fast moving average of 20 days crosses above a slow moving average of 50 days, signaling a strong trend. And it's vice versa for the shorts. This entry is pretty great at riding established trends, but tends to enter a bit late and sometimes leaves money on the table in sideways markets. And here's an example of the entry for DAX 40. We enter the trade here when the fast moving average crosses the slow moving average. Our third entry is a volatility momentum entry where we enter a trade when the price closes above the upper Bollinger Bands of 20 days, which is signaling an increased volatility and an increased momentum. For the short trades, we do the vice versa. We enter the trade when the price closes below the lower Bollinger Band of 20 days. This entry is pretty good at catching these explosive moves when the volatility expands, but it can often also fail with false breakouts during low volume sessions. So this is a clear improvement point to include volume as a condition together with this entry. Here we have an example of the entry in SP 500 where the price breaks up out of the Bollinger Bands and closes above the Bollinger Band. The fourth entry is a volatility expansion entry where we enter a trade when we have a breakout upwards after the narrowest range bar in the last 7 days, which is signaling an expanded volatility and a breakout. One strength with this entry is that it's quite good at spotting volatility squeezes that are about to explode, but it fails easily if the breakout lacks a follow-through. Here you can see an example of the entry on Nasdaq 100. Here we have a very low range in the 7th bar, which means that we enter the trade in the next morning.
How did you choose these different entries? And how did you choose the different numbers?
Yeah, you put me on the spot now because there isn't really any great thought behind the selected values. I just quite randomly chose an arbitrary value, and the point of this study, as I already explained, wasn't to find the best possible entry or to reach the highest possible returns, but rather to investigate what kind of entry works with which kind of exit. And then as a second step, of course, you can refine it, you can improve it, you can optimize these values. So this is actually what I just did when I coded the 10 ultimate algos, trying a bunch of new filters and new conditions. And again, if you want these algos, you can find them in the description of the video. The final and fifth entry is a price action entry, where we enter a long trade if we have a bullish engulfing candlestick, and for our short trades we are looking for a bearish engulfing candlestick. Engulfing means that the candle is fully engulfing the previous candle, which means that the open and close of the candle is exceeding the previous candle, like this, signaling a strong movement. So this is a simple and quite intuitive pattern that works well in finding these turning points in the trend, but it loses its reliability in strongly trending environments. Here we have an example of the entry in DAX 40, where we have a downtrend here, which is followed by this bullish engulfing candlestick, and then we enter the trade in the next morning. So that were the 5 entries. Now let's go through the 10 different exits. Our first exit is a time-based exit, where we simply exit all trades after 5 trading days. So this is the same for both long and shorts. And as you understand, this exit is fast, it's consistent. But the bluntness of this exit often leaves money on the table during strong trending markets. So here is an example where we enter the trade here, 5 trading days passes, and then we exit the trade here on the 6th morning. Our second exit is a trend following exit using the moving averages. This is the same moving averages as we used in our entry. So we exit a long trade when a fast moving average of 20 days crosses below a slow moving average of 50 days. So this is a clear indication of a decline in the trend strength. This exit allows big winners to develop in trends, but it may lag significantly in exits when the trend reverses sharply, which makes you lose unrealized gains. So this is the vice versa for short trades. Here you can see an example of the exit on SP 500. Here's where we exit the trade when the slow moving average is crossed by the fast moving average. Our third exit is a mean reversion exit, where we exit the trade when the price deviates too much from the mean, which is signaling an overbought or an oversold condition. Again, we use the RSI 14 indicator, where we, for long trades, exit the trade when RSI 14 reaches 70. And for short trades, we exit the trade when RSI 14 reaches 30. So this is an efficient exit where we lock in gains when price returns to the mean, but it's a bit vulnerable if the momentum continues past this mean level. Here is an example of the exit on Nasdaq 100. We entered the trade here, and then RSI 14 reaches 70, and then again we close the trade in the next morning. So this is the same values and indicator as we used in the RSI entry, but reversed for the exit. Our fourth exit is another trend following exit, where we use the parabolic FAR indicator. As you can see here, this indicator plots a series of dots above or below the price to signal potential trend direction and reversals. And we simply exit the long trade when the price closes below a dot, and we exit the short trade when the price closes above one of these dots. So here is the exit in action on OMXS30. We enter the trade here, and then the price closes below one of these dots, and that's when we exit the trade. Our fifth exit is a trailing stop exit, where we move up the stop level when the price reaches a 2% gain. So we are continuously moving the stop level to 5% under the highest price since entry. So this protects gains, it manages downside with quite good precision, but can get hit too early in volatile or wide-ranging markets. So here's an example of the exit on DAX 40, where we have moved the stop loss level, and ultimately the price goes below this level, and that's when we exit the trade. Our sixth exit is a simple target profit exit, where we close the trade when we reach a 5% gain. So this is the same for both long and short trades. Here is an example of the exit on SP 500, where we enter the trade here. After a few days, we have reached a 5% gain, and then we exit the trade in the next morning. So this is one of the simplest exits in this study. Our seventh exit is a volatility momentum exit, where we again use the Bollinger Bands. We close a long trade when the price closes above the upper Bollinger Band of 20 days. And it's vice versa for the short trades, where we exit the trade when the price closes below the lower Bollinger Band. Here you can see the exit on Nasdaq. We enter the trade here. After a couple of days, we have a price closing above the upper Bollinger Bands, and that's where we exit the trade. Our eighth exit is our third trend following exit, where we close the trade when the price closes below a trailing moving average. Here we use an exponential moving average of 10 days. And again, it's the vice versa for short trades. So we keep the trade alive during clean trends, but this exit can expose you to bigger drawdowns when the price do a sudden pullback. Here you can see the exit on OMXS30. This white line here is the exponential moving average. We follow the price up all the way here, and here the price closes below the moving average, and that's when we exit the trade. Our ninth exit is a momentum strength exit, where we exit the trade whenever we have 4 consecutive green candles for long trades, or 4 consecutive red candles for short trades. So this exit is smart for catching short bursts of strength and locking gains. But exits can trigger on noise rather than on true exhaustion. So there is a risk that you leave money on the table. And here you can see the exit for Dow Jones. We enter the trade here, and here we have 4 consecutive positive days, and that's when we exit the trade. Our 10th and final exit is our price action exit. It uses the engulfing candlesticks again, where we exit the long trade when we have a bearish engulfing candlestick, and we exit our short trades when we have a bullish engulfing candlestick. Here you can see the exit for Dow Jones. We are looking at a short trade here. So we enter the short trade here, and after a few days we have a bullish engulfing candlestick here, and that's when we exit the short trade. So that's the 10 exits that I backtested together with the 5 entries. And I did that for the 5 different indexes that we are now going to look at. So let's go through the results index per index, starting with the long trades of SP 500. The best entry across all exits were the RSI entry, where you simply enter a long trade when the RSI 14 is below 30. And the absolute best exit to combine it with was the moving average trailing stop, where you exit the trade when we have a close below the exponential moving average of 10 days. This exit was almost 4 times better than the second best one. Let's look at the backtest report of this entry and exit combination. So it's actually pretty great results in the last 30 years, and especially strong in the last few years, just straight up from here. And we can see that we were only in market 2.54% of the time. The win rate is only 52.78%, but we have an average gain that is 3 times bigger than the average loss. If we look at the worst long entry, that is the Bollinger Band breakout, which performed terribly across all different exits. I mean, with SP 500 making a couple of 1000% of gains since 1950, a swing trading strategy that goes long needs to show some great gains. Otherwise, you could just do better by doing a buy and hold. If we look at the perspective from the exits, the best one is the moving average trailing stop, and the worst one is the break-even plus trailing stop exit. Let's take a look on the short trades. By the way, I will share this document in the description of this video. If we look at the short trades, we can see that most numbers here are negative, and that is simply because most of these entry and exit combinations are losing money. And what does that tell us? Well, that it's difficult to go short on SP 500 in general, and with these entry and exit combinations in particular. So swing trading short on SP 500 is a contrarian game, and I would leave it for the daredevils. Negative results can still tell us something though. The worst entry is, just as it was for the long trades, the Bollinger Band breakout. The best entry is the RSI entry, where we simply just enter the short trade when RSI goes above 70. So there are no great results here for the short, but you actually do make some money combining the RSI entry with one of these 3 exits. So the parabolic SAR exit, the trailing stop exit, and the moving average trailing stop exit. The best short exit across all entries is the 4th consecutive bar exit, where we exit the trade when we have 4 consecutive negative days. The worst exit across all entries is the moving average trailing stop, where we exit the trade when the price closes above an exponential moving average of 10 periods. Okay, so let's note the best entry and exit combination for every market. So SP 500, the best combination for long was the RSI entry together with the MA trailing exit. And for short trades, it was the RSI entry together with the break-even trailing stop exit. Let's take a look at the next index, Nasdaq 100, starting with the long trades. With the strong trend of Nasdaq 100, we see a lot of big numbers here for the long trades. The best entry is, just as it was with the SP 500 index, the RSI entry. And just like with the SP 500 index, it works best with the moving average trailing stop, but it also works very well with the parabolic SAR exit. And if we look at the short trades, we see a slightly better result overall compared to the SP 500 index, but it's still evident that shorting is more difficult than going long. The best short entry for Nasdaq is the moving average crossover, and it actually works pretty well with the break-even trailing stop exit. I mean, it's not amazing, but considering the fact that these are very basic and non-refined entries and exits on a strongly trending market, I would say that this entry and exit combination is promising, and it's something worth considering working more on if you would like to build a shorting strategy for Nasdaq. If we take a look at the backtest of that, we see that this strategy is in the market less than 1% of the time, so it's not trading very often, and when it does, the average trade duration is 1 day. We have a 52% win rate and a profit factor of 1.59. And I think the results graph looks pretty okay from around here. So Nasdaq, the best combination for long was the RSI entry together with the MA trailing exit. For the short trades, the best combination was the MA crossover entry together with the break-even trailing stop exit. Let's look at Dow Jones. So for the long trades, it's once again our mean reversion RSI entry that performs best overall. It's actually 3 times better than the second best. And just as it was with Nasdaq, it's best combined with the parabolic SAR exit and the moving average trailing stop exit. Let's take a look on the backtest using the moving average trailing stop exit. I really like how this graph looks like from around year 2000 here. Barely any drawdown at all. It's looking good both in bullish and bearish periods. We have a profit factor of 2.37 and a time in market of less than 3%. The best exit across all entries was the parabolic SAR exit. If we take a look on the short trades, we have some differences with the Nasdaq market. Here the worst performing entry was the moving average crossover entry, which was the best one for Nasdaq. The best entry was the RSI entry, and combining it with the 4th consecutive bar exit, which is also the best exit across all the different entries. Okay, so Dow Jones, the best combination for long was the RSI entry together with the MA trailing stop exit. The best combination for short trades was the RSI entry together with the 4 consecutive bar exit. Okay, let's take a look at the 2 European indexes. Let's start with the long trades for DAX 40. Again, the RSI entry proves to be strong here as well for the long trades, but for the DAX markets, it's better combined with the fixed bar count exit, where we exit the trade after 5 days. And it's also great to combine with the 4 consecutive bar exit. But there's actually no big difference in the results between the exits here. Most perform quite well. Just avoid the moving average trailing stop exit and the parabolic SAR exit that actually loses you money. The best exit across all entries is the engulfing candlestick exit, where we exit the trade when we have a strong bullish candlestick engulfing the previous candlestick. On the short side on DAX, the RSI entry is truly terrible. We have huge losses with this entry with all different exits. I guess most entries actually loses you money on the short side, so I would think twice before shorting DAX with any of these entries. The combination that performs best is the Bollinger Band breakout entry combined with the trailing stop exit, which is also the exit that works best across all entries. So DAX, the best combination for long was the RSI entry together with the 4 consecutive bar exit. For short trades, the best combination was the Bollinger Band breakout entry together with the break-even trailing stop exit. Let's take a look at the last index, which is my home index, the Swedish OMXS30 index that differs quite a lot from the other ones. The best entry for the long side is the MA crossover entry, and you should combine it with the fixed bar count exit, which is also the exit that works best across all the different long entries. The worst long entry is the Bollinger Band, and the worst exit is the moving average trailing stop exit. On the short side, the best entry, although still negative in total, is the engulfing candle entry. However, it actually makes you some money together with the parabolic SAR exit and together with the break-even trailing stop exit. But the break-even trailing stop exit works pretty bad on the other entries. The best exit across all entries is the Bollinger Band exit, which I find quite surprising actually. So OMXS30, the best combination was for long was the MA crossover entry together with the fixed bar count exit. For short trades, it was the engulfing candle entry together with the break-even trailing stop exit. So what did this study tell us, aside from what I just showed you, or told you, showed you? Well, the first point that is evident is that a combination of entry and exit that works well on one market doesn't necessarily work well on another market, even though these markets are heavily correlated. So markets are not the same. So this means that you need to do your own analysis and your own backtests if you would like to use these entry and exit combinations for another index. Each market has its own personality, and like for the OMXS 30 seems to be rewarding trend following combinations, whereas the DAX 40 punishes mean reversion combinations. So you need to do your own analysis on the index that you want to run these entries and exits on. So backtest with care and don't assume what works on one market works on another market. I think another takeaway is that the mean reversion entry using the RSI 14 indicator works well on multiple markets with both long and short trades. It's the best performing entry in 6 out of 10 instances, and it's not just good, it's often 3 to 10 times better on long trades than the second best one. So RSI 14 equals a very happy face. So if you're only going to test one entry, this is the one that you should test. Avoid using it on DAX for shorts though, where it was the worst performing entry. We can also conclude that the break-even trailing stop works great for shorts. Break-even trailing stop for shorts equals also a happy face. However, for long trades, it kills your gains prematurely. So break-even trailing for longs equals a sad face. So test it before trusting it. It has consistently low gains compared to its time in market, and in some cases it returns negative values even with decent entries. I think that we can also conclude that you should avoid the moving average trailing stop for short trades, being the worst performing exit in 3 out of 5 instances. A trailing for shorts is a bigger sad face. For long trades, it works pretty good though, but only for the US markets. Ultimately, we can definitely conclude that the Bollinger Band entry is a bad idea overall for both long and short trades. Bollinger Band's a big sad face. It's the worst performing entry in 8 out of 10 instances. Whoever said that the Bollinger Band entry was a great entry was just bullshitting. This is the worst shit I've ever seen. The only exception is for short trades on DAX 40. So these are the insights that I based the 10 ultimate algos on, and I would like to show you 2 of my favorites. The first one is the long algo for Nasdaq, where I use the RSI entry together with the MA trailing stop exit. I first lowered the stop loss down to 3.7%. For the entry, I changed the RSI value from 30 to 31. In addition to that, I noticed that September is a weird month for this code, so I completely prohibited the strategy from entering any trades in September. For the exits, I changed the MA trailing stop value from 10 periods down to 3 periods, and I added a volatility filter that the Bollinger bandwidth must be over 0.12. And lastly, I changed the zombie trade exit to exit the trade already after 2 days if the Bollinger bandwidths are over 0.09. And that gave me these results. We have a profit factor of 13.38 with a win rate of 63%. We have a total gain of close to 15,000 euros with only 801 euros drawdown. The average gain is 8 times bigger than the average loss, and I think this equity curve looks quite great. Please note that this strategy, although ultimate, has a high risk of being overfitted. The second ultimate algo that I really like is the long algo for SP 500. Just look at the results here from around year 2000. We have a win rate of 52%. We have a profit factor of 4.57. And with a gain of 2,107 euros, with only 2.18% time in market, we get a great leverage for our capital. The max drawdown is around 1/9 of the total gain, and the improvements that I did was to, well, first I took the best combination of entry and exit, which again was the RSI entry together with the MA trailing stop exit, and then I added the Bollinger Band widths again to only enter trades when the width is over 0.06. I kept the stop loss and the RSI values as is, and then I added a condition to not enter trades in the second half of December. I also added a target profit that is 2 times bigger than the stop loss, so a target profit of 10%. For the exit, I changed the MA value from 10 down to 8. And lastly, I changed the zombie trade exit here to exit the trade already after 12 trading days instead of 20. These are 2 out of the 10 algos. You can find all the 10 algos in the description of this video. By the way, again, if you would like me to backtest something else, send me a comment below. I'm interested in all your ideas. So what use is this study? Well, whether you are just getting into swing trading or if you are an experienced swing trader, the difference between what feels right and what is right can make a huge difference and can cost you months of gains. One of the most common mistakes that traders do is to combine a good entry with a poor exit or a good exit with a poor entry. And then they blame the entry or the exit or even the market, but the real issue was a mismatch between the two. So this study shows that the entries and the exits aren't plug and playable and independent of each other, they interact. This study had no optimization, no filters, and that was the purpose because I wanted to investigate how these entries interact with these exits, and I wanted to do that by looking at the raw, unrefined structure of these different kinds of exits and entries. If you don't want to use my ultimate algos, the ones that I coded, you could actually code your own algos based on these insights. I would recommend that you go into the index that you want to trade, you take the best combination of entry and exit, and then you start building out of that. You could try something like re-optimizing the RSI values or trying another RSI value. Maybe RSI 30 is better than RSI 14 or even RSI 2 or RSI 5 or whatever. You could try adding a couple of filters, perhaps a moving average filter where you only enter short trades if the price is below the moving average of, let's say, 200, and you only enter long trades if the price is above the moving average of 200 or 50 or 100 or whatever. You could also explore maybe some volatility-based exits. You could try testing these combinations on another time frame. You could try testing these combinations on another index. You could add a day filter. You could add a month filter. You could also consider adding volume as a criteria for entry. So basically, this study is a launch pad. Now you know which combinations of entries and exits work, and that gives you a head start when you start coding. So this isn't just about numbers, it's about making better data-driven decisions as a trader. So what did we learn? Well, we tested 500 different trading strategy combinations, and we found that some entries like the RSI 14 entry are consistent and solid across multiple markets. We found that some exits, like the moving average trailing stop exit, amplify those entries, but only in the right context. And we also find that other exits, like the break-even trailing stop exit, sound smart, but almost always ruins your trades. And perhaps most importantly, worth repeating, entries and exits need to be designed as a system, combining the two, not just as a list of individual components. If you want the full pro real-time code for all 100 entry and exit combinations, it's right in the video description below, ready for you to download and experiment with. I hope this gave you some real practical insights and that it gave you a shortcut in your algo development journey. And if there's something that you are curious about, if you have any questions about the study, if you want me to backtest something else, drop me a comment below. I read and I answer everything. And that's it. Thank you for watching. Thank you for subscribing. Thank you for your thumbs up. I will see you in the next one. Bye.